The tech industry's landscape has been dramatically influenced by the surge of generative artificial intelligence, AI, this year, igniting a substantial rally that has had a profound impact on the entire U.S. stock market. Tech companies have been eager to extol the virtues of generative AI, heralding its potential for groundbreaking advancements. Yet, amidst these lofty aspirations, a notable absence persists. A concrete timeline predicting when the financial ramifications of generative AI will truly manifest within the industry. As the dust settles on recent earnings reports from major players, the uncertainty surrounding the impact of this technology on both costs and revenues comes to the forefront, demanding a closer look at the intersection of optimism and fiscal reality. The spotlight has recently fallen on the second quarter earnings reports of some of the biggest players in the U.S. tech landscape, including Alphabet, Amazon, Apple, Meta, and Microsoft. These industry giants managed to surpass market expectations with their financial performance. However, a recurring theme emerged from these reports that left many intrigued. The reluctance of these tech titans, along with others venturing into the realm of generative AI, to provide precise forecasts regarding the arrival of new AI features in their products and services, as well as the pricing strategies they intend to adopt for these technologies. This dearth of concrete information has left investors grappling with uncertainty about the eventual financial implications of generative AI. Following Amazon and Apple's recent quarterly earnings releases, Brent Thill, an analyst at Jefferies, aptly encapsulated the sentiment permeating the investor community. The hype is here, the revenue is not. Amidst the anticipation and uncertainty surrounding the impact of generative artificial intelligence, the earnings season has provided a stabilizing influence on this year's remarkable surge in share prices. Some of the tech behemoths, including Meta, Amazon, and Apple, have witnessed their stock prices climb by more than 50%. This uptrend, even in the face of uncertainty, can be attributed in part to an uncharacteristic emphasis on cost discipline that has played a pivotal role in their earnings outperformance. This newfound cost discipline is a noticeable departure from the usual narrative of these tech giants being singularly focused on unbounded growth. Earlier in the year, an uncommon occurrence of job cuts underscored their determination to streamline operations. Amazon, for instance, made a significant reduction of around 27,000 positions, while Google's workforce shrank by nearly 9,000 during the second quarter. Of particular significance, Amazon has managed to rein in its soaring costs, a welcome development after experiencing cost escalation in 2022. In the second quarter, the company's operating profit margin reached 5.7%, a notable 2-point increase from earlier in the year, marking its strongest performance in a span of 2 years. This unexpected improvement caused a surge of almost 9% in Amazon's shares during after-market trading, translating to an addition of around $120 billion to its market value. Apple, in its earnings report, disclosed a minor 1% dip in revenue, partly attributed to subdued consumer spending on gadgets. However, cost containment emerged as a strategic response to navigate the challenges posed by an unsettled economy. Chief Financial Officer of Apple, Luca Maestri, acknowledged the uncertainties that have marked the past few quarters and affirmed their success in controlling expenditure. He highlighted Apple's ability to effectively slow down spending growth, even as the company strategically increased its investments in research and development. This newfound emphasis on cost containment, however, intersects with the emergence of a new investment wave generated by the prospects of generative AI. The looming question is whether this era of heightened spending discipline within big tech will remain sustainable in the face of these evolving technological paradigms. Jim Tierney, a growth stock investor at AllianceBernstein, aptly points out that the belt tightening observed in late 2022 and early 2023 might have been a temporal phenomenon. The pivotal query remains: will the robust margin rebounds experienced in 2023 prove to be momentary? Microsoft, known for its swift integration of generative AI into its existing suite of products and services, is gearing up to face the implications of increased spending. The company has already exhibited a noticeable uptick in its capital spending, with the latest quarter reporting $10.7 billion, surpassing Wall Street's expectations. Moreover, Microsoft projects that its spending will continue to rise over each quarter of the current fiscal year that commenced in July. According to predictions by analysts at Morgan Stanley, Microsoft's capital spending, primarily directed towards areas such as data centers and associated equipment, could soar to $50 billion over the next 12 months. This projected figure represents an increase of over 50% compared to the previous year and more than double its spending from just 2 years prior. The data reinforces the notion that the march of generative AI will continue to test the newfound cost discipline that has marked big tech's recent performance. As they report their latest earnings, the question of how generative AI will impact their financial landscape looms large, leaving investors eager for clarity. The second quarter earnings of prominent tech behemoths, including Alphabet, Amazon, Apple, Meta, and Microsoft, managed to surpass expectations. Yet, a recurring theme has been the absence of precise forecasts regarding the timing of generative AI's integration into products and services, as well as its corresponding financial implications. This dynamic has sparked a unique situation in which heightened spending discipline, typically associated with growth-focused entities, has taken center stage. Companies such as Meta, Amazon, and Apple have demonstrated their commitment to curbing costs, underpinning this year's substantial surge in share prices. Uncharacteristically, this discipline in cost management has contributed to their earnings outperformance. However, the intersection of this newfound fiscal restraint and the rapid ascent of generative AI presents an intriguing conundrum. There is growing concern that this moment of cost discipline may be fleeting in the face of AI's impending impact on technological advancements. Microsoft, renowned for swiftly embedding generative AI into its offerings, is on the cusp of experiencing the financial implications of this transition. The company's capital spending has already surged, surpassing market expectations. Microsoft anticipates a continued increase in spending throughout its current fiscal year, which commenced in July. The looming question is whether this financial discipline can withstand the tide of generative AI, which is poised to drive new investment trends. Microsoft's CEO, Satya Nadella, asserts that this higher spending is tied to anticipated revenue growth, positioning it as replacement capital plus some new capital that is going to drive new growth. Other industry leaders, however, are more cautious in their predictions. Mark Zuckerberg, Meta's chief, acknowledges the uncertainty surrounding the pace of AI product growth, underscoring the difficulty in gauging the necessary investment. Despite this ambiguity, tech executives emphasize that newfound cost disciplines are here to stay, signifying a period of growth accompanied by improving margins rather than growth at any cost. Amazon's CEO, Andy Jassy, highlighted that the generative AI landscape is still in its nascent stages, with the industry being only a few steps into a marathon. Jassy acknowledged the transformative potential of generative AI, particularly within Amazon Web Services, Oz, where customers recognize its value. However, he noted that most companies are still exploring how to approach and train models in this domain. In Amazon's case, generative AI initiatives are a pervasive force, embedded in every aspect of its business. Jassy emphasized that generative AI would be at the heart of Amazon's future endeavors. Similarly, Microsoft is taking strategic steps to integrate generative AI into its products and services. Despite the anticipation, both Amazon and Microsoft are cautious in their predictions of the technology's imminent financial impact. The evidence linking generative AI to substantial revenue growth across the industry remains scarce. Amy Hood, Microsoft's chief financial officer, indicated that the revenue impact would be gradual, as new features are launched and gain traction with customers. However, these tempered expectations were met with mixed investor sentiments, with Microsoft's stock price experiencing a 7% dip in the aftermath of the earnings call. Thanks for tuning in to today's video on the General Finance channel. We hope you found it informative and valuable. Remember, we'll be posting new videos on the channel 3-5 times per week, so make sure to hit that subscribe button and turn on notifications so you never miss an update. And don't forget, we want to hear from you. Leave your thoughts and feedback in the comments section below. Is there a particular topic you'd like us to cover in a future video? Let us know. Thanks again for watching, and we'll see you in the next one. Keep building that financial savvy, and we'll be here every step of the way to help you on your journey to financial freedom.